All right, so I'm going to do my best to share my screen here and make this work. Hang on one second, see if this works again. And all right, everybody see that okay?
Yep.
Yes, okay, good. All right, so I think our format that we talked about, and Ann, keep me straight here, but our format is I wanted to talk to you just about, well, quickly, I'm a financial planner. I work with a company called Trust Core Financial. So I'm here today in twofold to talk to you about FPA of Middle Tennessee. It's a financial planning association of Middle Tennessee, as well as our firm, Trust Core Financial. So what I'd like to do is maybe have this talk in two different sessions. Maybe the first 20 minutes, I want to give you maybe, I've said top 6 things for college grads to think about. So as you students, I think we had 1 or 2 seniors. As you get closer to graduation, here's some things that you need, in my experience, this is advice I would give you to think about as you go out on your own and into this great big financial world. Then I want to pivot for the second half of the conversation and talk to you about what it means to be a financial planner, what our firm is like, the roles that we have. That's why I've asked Taylor to come in here. He just completed the CFP exam, what that means. So I don't know if any of you have an interest in this industry, but I want to give you some exposure as to what it's all about. I think we talked about maybe leaving some time at the end for some questions, and so we'll do that as well along the way. So let me do this. Let's go over some of these topics I had as far as my top 6 for college grads. All right. So and I have 2 college students right now, so somewhat versed in this, and believe it or not, was a college student at one point myself. All right, so basically you graduate, you're out on your own. It's super simple, right? It's super simple to say, but it's really hard to do. It's things that your mom and your dad and your grandma taught you, but it's spend less than you earn. And and to do that, you cannot manage that which you don't measure. And I think that's a great little simple saying. You cannot manage that which you don't measure. And how do you measure that? How do you do that? You come up with a plan. So make a plan. And that plan has a priority to it. You're going to make income. You're going to have to pay tax. You have to pay any debts you have. You're going to have to save some money. And what's left over is what you can spend. So there's this dirty little word out there that people talk about, and it's called a budget. Budgets don't have to be super complicated. You can go on to the App Store and get some really cool apps. You can use Mint. You can use all kinds of different ways to get there. You basically spend all your money on paper before you actually spend it in the real world. Budgets are super powerful. We have clients that make $10,000 to $100,000 to $1 million a year, and having a budget is awesome. It's an awesome thing because you know exactly what you can afford to spend on what, and you know that if it's time to go take a vacation, you don't stress about taking the vacation, or it's time to buy the new car, you've got it in the budget, you've planned for it, you've allocated for it. So it makes those decisions actually very freeing. It's very empowering to be able to do that and to be able to work a budget. But the budget has to be monitored, you have to follow it, and you have to update it. So you have to spend some time on it. I have a budget for me and my family. I do mine in Excel, but whatever your process is, I urge you to come up with a plan. And not having a plan is just going to be a recipe for not meeting your goals. It's just not going to work. All right, Taylor, you want to add anything there? You good?
Yeah, one thing I think in our culture you see is recurring things, right? So like your Netflix, your Hulu account, all these things that you pay for monthly, just staying on top of those, making sure you don't have, $75, $100 in services you're not using. So really staying on top of it, trimming that list, and really sticking to your budget. That's what I would add.
And Craig, could I just also add,
Please do.
I know that this generation is also very big on using apps to pay for things. It's really hard to track what you spend when you're using your apps. So I encourage you to not use apps. And if you do use apps, you still need to track and what you're spending.
It can easily sneak up onto you. So you look up and my wife hates this conversation, but we do it every year. We sit back and we look where we spend all our money for the year. And because I track all that. And it's amazing how much you look back and go, gosh, do you realize how much we spent on eating out or how much we spent on this? You'll be shocked how much you spend once you get out there if you already keep up with it. Okay, second thing, number two, emergency fund. It's a simple idea. Things are going to happen in life, and you can be able to have some backup plan, some backup liquidity. This is not your investment account. This is not the new car fund. This is not go on vacation fund. And typically it's 3 to 6 months of expenses. You should have a good feel for what that is because you just did your budget. And I'm guessing for a new grad, you're out with your new job, it's probably $5,000 or $10,000 is enough, but it's probably somewhere like that in case you were to have to replace a car or fix a car, or something happens with your housing or what have you. You're able to get your hands on some money if you need it. So emergency fund is number two. All right, number three, and this is a big one, and it's super duper powerful. It's really important. Save 15% of your income. That's a goal to start. So when you start out at that young of an age and you get that first job, if you're able to put 15% of your income, hopefully you go somewhere to work where they have a company sponsored retirement plan. The current maximum you can defer into a company sponsored retirement plan is $19,500 if you're under the age of 50. When I say company sponsored retirement plan, I'm talking about a 401k, 403b, 457. It's typically a 401k plan. Once you start that way at 15% and you don't get used to spending that money, it's a fantastic thing. Your time horizon from that point, when you start your job and you're 22 or 23 years old and you're not going to use this money for 30 plus years, 40 plus years, it's going to compound like crazy. It's going to be worth so much money at the end of the day, and you'll be very glad you did it. What you have that I don't have right now is you have time. I'm 48. I'm not 22. I can't go back and give myself a 40-year runway and put that money in there, but you can. And it's a once in a lifetime type of opportunity to start out with that discipline of saving. Now, this is not saving for again, the new car fund or the vacation or whatever. This is saving for retirement. Couple of benchmarks here that I think are worthy goals. If your company has a match, meaning the way 401k plans work is if I put in $1,000, my company will put in $1,000 with me. And so there's a match limit, and sometimes it's dollars, sometimes most of the time it's percentages. So if I put in 5%, they'll put in 3%. So they match it some dollar amount. At a minimum, you should shoot for getting the most match from your company. If you do that, it's free money. It's automatic 100% rate of return, however you want to say it. They are giving you money, and you're leaving money on the table from that new job you just got if you don't participate in the plan. Now, there'll be a vesting schedule. You'll have to work there so many years before you get it, but it's a fantastic thing to do. So your goal, as far as I'm concerned, is to at least start with 15% of your pay or at least get the match from your company. Okay. Now, you can also, as you get pay increases over time, you can increase that. So when you get a pay raise, take it to 16% on that time, and you'll never feel it. You'll still get a pay raise, and all of a sudden you're now saving 16%. So that's just a little trick to help you increase your saving amount. So when you go down I-24 and you're heading toward Chattanooga and you look up on Mont Eagle Mountain, there's a big giant building you can see up on the mountain. I think it's on Mont Eagle, I think. It's Sir John Templeton's library. So Sir John Templeton is from Manchester, Tennessee. I think he may have passed away now, but he was knighted by the Queen of England. He's a famous investor. He has this famous quote: he saved 50 cents of every dollar he ever made. So being able to save that amount of money, it just compounds and it grows into a huge amount over time if you invest it. A couple of other quick things. There are two different buckets you can save in. Typically, when you go into a company-sponsored retirement plan, a pre-tax or a Roth. And without getting too much in the details, I would strongly encourage you to consider the Roth account. And the way that works is it doesn't help you with your current tax bill. You get no benefit on your current taxes by putting this money into this company retirement plan, this 401k. But all of the amount, all of the growth on that account, 40 years later, 30 years later, 50 years later, is tax-free, every penny. So if you put in $10,000 and it goes 10x or 20x and it's worth $100,000 or $200,000 in 40 or 50 years, you can take out every penny of it and you don't owe a dime to the government. There are very, as Ann can tell you, and everybody else can tell you, Kerry and Taylor can tell you, there are very few things in this world where you don't have to pay any tax. And this is one of them. And it's a fantastic opportunity for somebody as young as you are and your time horizon. They also have target date funds in there. They are really easy to use. It's a good thing to use. It's not a cop out. It's a simple strategy to get started.
Craig, you might want to explain what target date means.
Sure. So inside a 401k plan, you're going to have investment options. And those investment options, very simplistically, they'll give you a suite of target date funds. And these target date funds, meaning what is my time horizon when I want it to end? Meaning when am I going to retire? So in your case, there's going to be a 2050, 2060, 2070 fund. And those are very appropriate for you. They're going to be predominantly invested in stocks, and they target that date for your retirement. So you pick the date that matches your retirement date. Well, if I'm 22 years old and I've got 40 years to go, it's probably a 2060 fund or a 2050 fund. And those are fine. They're a great way to start. It's not, again, like I say, I always tell people they're not a cop out. They're professionally managed. They work fine. And so I would absolutely start there.
Yeah, and to add that a little bit, I think you see in our field that there are a lot of blue collar workers that end up with $3-4 million in their nest egg because they followed this simple strategy. They're savers and not spenders. So I think we live in a culture where you make more, you spend more. I think everyone kind of falls into that treadmill or that cycle. What I would encourage you guys to do, to Craig's earlier point, is that if you can start at 15%, to Craig's point earlier, and that goes up to 16%, then just live on what you're used to and never consider that extra money your money. Pay your future self. And if you can do that and let that compound over time, you're going to be very happy with the results. In the last date, the target date funds, I kind of think of it as like a runway, right? Like it's going to go really fast at the beginning. And as you approach retirement and it gets closer to 2050, 60, whatever date you're planning to retire, it's going to slow down a little bit and you're going to have your bucket and you're going to kind of figure out pretty early that you're either on pace or off pace. So you can't say enough about starting early here, guys.
I also, just very quickly to add, I think the important thing to remember is you're saving for retirement. And so there's going to be times where the market's down and you can't panic because you are saving for that long term. I think Craig would agree that during the financial crisis of 2007, 2009, many investors panicked and pulled their money out of the market when it was low. And if they would have just ridden the storm, they would have been much better off by just waiting and not selling when they felt like it was crashing. So understand you're saving for the long term and you can't react to every market move because you end up losing a lot of value.
That's absolutely right. We even saw that last year. The market dropped 30-40% last year and recovered within the same year, which is just crazy. But you know, you're a long-term investor. You don't need that money that year. So you have plenty of time to let it work for you. Okay, number 4. In some ways, I feel weird telling you to do this, but get a credit card. If you graduated, get a credit card in your name. You don't need mom and dad on it anymore. Now, I'm going to tell you to get a credit card and I want you to use it, but I want you to pay it off completely every single month. I want you to pay absolutely no interest on that credit card. I have a credit card. Somehow my family manages to wear it out every single month. I pay 0% interest. The credit card company has paid me literally thousands of dollars since I've had that credit card because I get cash back. You can actually make money from your credit card. Now you have to have the discipline to pay it off. Going back to that budget, have that budget. You know what you're going to spend if you need to buy gas, if you need to buy groceries. The Southwest credit card's awesome. You can get a companion pass if you spend enough. You get free flights. So there's lots of great deals out there on credit cards. You don't need a big, massive limit. You're just starting out. But what we're doing is we're building your credit history. And that's going to come back to help you very much later on when you go to buy a car, you go to buy a house, you go to get a loan if you need it. So let me be very, very clear. I'm not telling you to get a credit card and run up balances and not pay it off and pay 18, 19, and 20% interest. That is not what I'm telling you to do. But I am telling you to get one, use it, and pay it off every month.
This was easily one of the best things I ever did as a college grad. I graduated. I put my groceries on it. That's all I put on it. I put it on as I went through grad school. So 4 or 5 years of just putting groceries on it, paying it off. It's the single smartest thing I've done because it allowed me to purchase a home just after that. And if you live in Nashville or anywhere around Nashville, you know that in 2013, 14, which is when I bought my house, housing prices have soared. It's been the best decision. So I can't say this enough. If you're disciplined enough, this could be huge for you.
So Taylor, can you provide the connection between a credit card and purchasing a home? What was it that you were doing that helped you to purchase the home?
Yeah, so anytime you're making a large purchase, so in this case, a home, they're going to want to know that you're a trustworthy person. You have a track record of paying your bills. And as a 22-year-old in college right now, you might be a great person, but no credit agency knows that. They don't call your parents or your friends and say, yeah, they're good for their word. They want to see that you've paid your bills over time, that you're timely and disciplined. So just that simple task of me doing this, and my limit on my credit card, I think, was like $2,000. So I mean, that's probably what you should expect. But it's proving your worth. It's proving your word is good. And then the moment you are ready to have a housing conversation, you're able to do that. So you're going to be able to have that conversation in a serious manner. But also interest rates are going to be in your favor, right? So interest rates now are historically low. If you have poor credit, you're not going to get the best interest rate, right? You're going to have to do some other things in order to even qualify. So that this goes a long way.
All right. Number 5. So I'm a car guy. I love cars. Made a few mistakes buying cars, and so don't want you to do that. So you graduate from college, time to buy a car, or you just want to buy a car. First thing I would tell you, what I tell my clients is let's look to purchase a vehicle that's 2 or 3 years old. Typically cars lose 30% when you drive them off the lot. You buy a car that's still under warranty. You can get certified pre-owned. There's lots of ways to do it. But I'm not against buying new cars, but my guess is for a new college grad trying to put all the pieces together, a brand new car is probably not the right decision. So let's have reliable transportation. Let's get our financial house in order. Let's get our budget going. And if we need to buy a new car, let's buy one 2 or 3 years old. A couple of other things that more style points for me, just in my experience over time, my goal is to pay cash for the car and or put a really big down payment on it. If I need to finance it, and that can be okay, it's not my first choice, but if I need to do it, I really strongly look to keep it under 36 months. I want a 36-month loan. Now, why do I say that? Because car dealers, the first thing they ask you is, what do you want your payment to be? Because they want to stretch it out super duper long. The longer the term of the loan on a car loan, the higher the interest rate. And also, a vehicle is a depreciating asset, meaning it goes down in value over time. So if I get a big loan on a car and I put a 72-month loan on it, the first 2 or 3 years I own that car, I owe more than it's worth because it's depreciating and my loan is not going down very fast, and I'm paying a higher interest rate. Those are 3 very bad things. So if I get a car and I have to finance part of it, I want to pay it off in 36 months. I want to be done with it. I want to have a loan that has no prepayment penalty. And I typically, if I do it on a 36 months, I'm going to get the best rate. So just from experience, that makes the best sense to me. And you can get loans like that on used cars. So it doesn't have to be a new car, to get a loan. Any questions on that? Okay. Number 6, housing. So you've gotten the job, you've worked for a while, you're trying to figure out what to do next. You may have already started renting. So here's just some guideposts. These are not end all be all recommendations. You have to make all this fit into your budget, but they're good estimates as to how much you should spend on housing. So no more than 28% of your gross income. So this is income before tax on all housing costs. So this would be mortgage or rent. If you're renting, you won't have property taxes. You may have rental insurance, renter's insurance. But if you buy, then it would be a mortgage, property taxes and insurance. So 28% of your gross income, that means before you pay tax. And then on all debts, and again, these are benchmarks, no more than 36% on all debts, car payments, student loans, credit cards, medical debt, all that stuff. It's got to fit in that box. One thing that we've seen time and time again, what the bank will loan you to go buy a house or buy a condo or buy a townhome and what you can afford are two totally different things. You can go to a bank and they say, hey, you're doing great. You're making $50,000 a year. You can afford this. Well, that's how much the bank will lend you. That's not how much you can afford. That's not how much you need to have in your budget. So that is not budgeting. That's just how much they're willing to pay to give you to make the purchase. Home ownership can be great. Home ownership is not for everybody though. And there's nothing wrong with renting. You just have to do the math and make sure that it makes sense for you. So we always shoot for having 20% equity down when we do house purchases for clients. We always really shoot for having a 15-year loan. When you start with a 15-year loan for a mortgage, you're going to pay more in principal on every payment than you are interest, which is great. If you start with a 30-year loan on a mortgage, your first 2-3 years of payments are all going to be interest, and it's just the way the amortization schedule works. I fully recognize if I'm starting out, I may have to go to a 30-year loan just to keep my payments reasonable. But again, the goal we have for our clients is we always try to see if we can't get them to a 15-year loan. The rate's going to be a little bit better, and the amortization schedule is going to absolutely work in our favor. So again, guideposts. I think so at the end of the day, all these things we just talked about is really just having a plan and having that plan work for you when it comes to emergency fund and saving for your future and how, knowing what you're spending on cars and houses and those kind of things. It is a very empowering feeling. You graduate from college, I see it all the time, and you rush out and quite frankly, sometimes you make some really dumb decisions. I know I did. I've seen it happen. And so I'm just trying to encourage you that there are some things you can do, some decisions you can make that will have a big impact, and you'll feel really good about what you've done. If you go ask your future self, should I really have bought that when I just graduated from college? More times than not, the answer is no. So. All right, Ann, do you want to do questions on this part here, or do you want us to just keep going?
Totally up to you.
All right, so let's ask questions. Any questions from the group on this part?
Okay.
All right, so let's shift gears a little bit. And I'll leave this up here while we talk, just because this is our this contact information if you want to learn more about FPA, Middle Tennessee. And I want to tell you a little bit about what I do, what we do as a team and TrustScore in our firm. So 2 steps. So FPA Middle Tennessee is the Financial Planning Association of Middle Tennessee. I serve on the board. Our executive director is on the call with us today, Kerry, Dunn. But what we are is we're an organization of financial planners. So we are firms that are, we advise clients to help them meet their financial goals. The majority of us are certified financial planners. That is a designation that we had to meet educational and test requirements to get. So it is an association of professional financial planners. TrustScore is one of the firms. A lot of people from TrustScore are part of FPA of Middle Tennessee. FPA is a national organization, and we have a chapter here in Middle Tennessee. If you are interested in anything that I'm about to talk about or anything has to do with financial planning firms, I would encourage you to go look at the website, contact Kerry Dunn. I put my email up there as well. Contact me, and I can get you in touch with our next meetings. A lot of them are online, and just learn more about what financial planning firms are and who they are and what they do. So as far as TrustScore, so the firm that I work with, it's called TrustScore Financial. We were founded in 1984. We work with clients in about 40 states. We manage about $2.3 billion for clients across those 40 states. We have about 45 people total in the firm, and we're probably a firm you've never heard of. And I think that's probably not not too uncommon in the world of financial planning. There's some big players out there. There's some big banks, there's wirehouses, there's insurance companies that you have heard of, but there's a lot of great private independent firms, very successful, do great work that, if you're interested in this career, in this industry, that's one thing that FPA has done, is trying to make you aware that there's some great opportunities out there. There's great careers in what we do, I think. So our basic value add, our basic model at TrustCore is we sit down with families and help them build a financial plan. Those big six I just talked to you about, budgeting, retirement savings, those kind of things, those absolutely line up with what we do for our clients. So we get into, building a cash flow plan, knowing what your net worth is, getting into investment strategy. How do you manage your portfolio? Retirement planning, tax planning, education, charitable, estate planning. I mean, all these different disciplines. And that's what the certified financial planner, that's what financial planners do. What I would tell you is the way TrustCore is modeled, the way our business is set up, we are not a sales-driven organization. Some would argue with that, I guess, as the industry, but I always like to view myself and what I do. We're an advice-driven model. So we step alongside of our clients and we do our best to help them make decisions on what life has to do, what the financial lives, the decisions they have to make in their financial life, and make really good decisions. So we help them decide how to invest their 401k. We help them decide, what does my estate plan need to look like? We help them decide, how should I do tax planning, or how should I give away money to charities? So it is a huge undertaking. There's lots of knowledge you have to gain and expertise you have to get to, but it's a great career. It's a fantastic thing we do. So the team that I work with, I've been at TrustCore for 23 years. We manage over $400 million on my team. We have 6 people on the team, and that's why I've asked Taylor to talk here in just a second, because he just finished the CFP exam. I wanted to let him give his story. But for me, I am hardwired to serve people. I'm hardwired to put clients first. It's the core of who I am and what I do. And so for me, why this career resonated with me is it let me serve people. It let me add value to their lives, and they're genuinely happy with what we do, and I get paid to do it. And so for me, that's perfect. And so for you college students, as you get closer to graduation, and you seniors they're right at graduation, and I've had the same conversation with my children. I have a senior at college right now. It's hard to figure out what's next. It's hard to figure out what I want to do. And what I would encourage you is the goal is to find something that you truly love to do. And it's gonna make life, you have to put a whole lot of energy into something if you don't enjoy doing it. And you can do it for the money for so long, and then at some point it's just not worth it. The money's not worth it. So those are lots of long conversations. There's no easy answers. I'd also encourage you, it's not always the first step. It's not always the first job you take that ends up being the best job that you end up with. And you may know statistics on how many times you change jobs over your career, but it's multiple times for most people.
It actually used to be you didn't change jobs, but now I would say it's every 3 to 5 years max that you're looking for another job. So it's quite frequent.
It is. And so my path, I actually studied finance and international business. I was a double major undergrad. And then I actually went to work as a research analyst. I was a stock analyst at a company called J.C. Bradford and Company. And so I was very heavily on the investment side. And then I came here and started working on the planning side. I spent a lot of time and effort on professional designations, becoming qualified in what I could do. I'm a certified financial planner. I'm a chartered financial analyst. I'm a certified investment management analyst. So I've done the work and what happened, and I guess in my story is my father had actually started our practice. And so I didn't have the experience. And so I spent all the time I could getting the professional education that I could get. And then you can't rush the experience part. so I was able just to learn from him and learn from our team over time. And that's what's made us successful, is being able to have these mentorships, to have these opportunities to learn from planners that have done it before, how to treat people, how to serve people, how to put their interests first, and how to help them navigate some pretty complex decisions. What else can I tell you? So I'm going to turn over to Taylor here in just a second. So the basic kind of requirement to be in the financial planning industry is the certified financial planner designation. So if I'm in school, if I'm in your place, thinking about the classes I've taken, whether I'm a finance major or a business major, those are appropriate in that if you've had any sort of finance classes on investments or accounting or taxes, those kind of things, they'll translate over into what you study and what you have to meet for the CFP designation. But so Taylor has had a different path. He joined our team. We have 6 people on our team here at Trust Corps. He joined our team 7 months ago. And I thought it might be interesting for you to hear his story, because he didn't start out doing this. He did a different path. And he recently, just actually in the last few weeks, he passed the CFP exam on the first try, which is actually not an easy thing to do at all. And so I thought it'd be great to hear his story, how he got there, and then walk us through what the CFP prep was and how you had to take it and all those kind of things. So I'll let you go.
So yeah, my name's Taylor. I joined Trust Corps 7.5 months ago. I was in the financial planning industry, or I should say the financial sector, for about 4 years. But my life transition, to Craig's point, was very irregular, I would say. So I went to the University of Tennessee. I graduated in 2012 with an education degree. I didn't really know what I wanted to do. My dad's a teacher. I knew I wanted to help people. Like, that's the one thing I knew I wanted to do. And my mom cuts hair and I can't cut hair. So I didn't know what I wanted to do. I just knew I wanted to help people. So I worked an internship at a hospital where I worked at a alcohol and drug rehab. And that made me feel good. Every day leaving work, I thought maybe I touched one person differently, so they're going to live their life maybe a bit different. So I did that for 4 years, and I kind of grew in the industry. I was ready to take the next step. I didn't know really what I wanted to do, so I wanted to get my MBA, and I did. I got my MBA, and this is when I was full searching for another job. So to an earlier point with Ann and Craig, it's okay to change jobs. Like, something that I think my parents and maybe your parents grew up in a culture where you stayed at a job, you got your pension, and you retired, right? It's just not the way of the world anymore. So it's okay to change jobs, and I had to be okay with that. So I got my MBA from Bethel University and decided to do something different. So I joined the financial industry, and I wanted to make sure that I wasn't giving up any of my core values. So the first job I had was at Edward Jones, and they trained me to be a good salesman. I didn't feel great about it. I knew I was helping people still, but it was still a little not right. So fast forward, I knew I wanted to do something other than just sell mutual funds or stocks and bonds. And so I heard about the CFP, which is what Craig has spoken about. It's an exam that you have to take. It takes a year of prep. So you have to take an educational course. I took mine at Belmont University. I completed that in January of this year, and I sat for the exam in March of this year. So March 12th, took a 4-hour exam. It's supposed to take somewhere in the 4 to 6 hour range. It's 170 questions, 85 in the morning, 85 in the afternoon. And it was really, really hard. So very blessed to have passed that exam. It covered all of those categories that Craig told you about: insurance, estate, investments, drawing a blank on some of the others, but just taxes. I mean, it was all over the board, and you have to be in the weeds. It's not asking you, what form do you file your taxes on? It's asking you very specific questions about tax planning. So I passed that, and I'll tell you, my path to where I'm standing today is not normal in our industry, but it's possible. So I say all of that to say, do what makes your heart happy, that where you go to work, you feel like you're accomplishing something and striving and growing as a person, because in that 3 to 5 year window, you're likely going to change jobs, and that's okay. So my path, a little different than Craig's, I'd say a little different than some people's. But where I am today, I know I haven't given up any of my core values. I know every day I'm helping people. I'm not helping them to not use drugs and alcohol anymore. That's okay. I'm helping them to save money and to potentially live on that money for sometimes 30, 40 years, which is really, really hard to do. So that's a little bit about who I am. I'm sure there might be questions for either.
So, hey, Taylor,
I want to highlight something that you did that I think students today are not thinking about. So what was the gap between your undergrad and your graduate degree?
Let's see, 3 years.
Right. And
So I went back to, I worked and had practical experience and did the hybrid course similar to what you guys are doing today, where some was in person, some was online. And I thought it was really cool because I think of my like 18, 20-year-old self, and I didn't want to go back to school. I was ready for the finish line. But I thought the practical experience and learning on the job, those kind of things that you get, whatever job it is really powerful.
I think that's an important point that I want the students to take away. I mean, I think the trend today is I'm going to do my graduate degree right after my undergrad, but I think Taylor did it right. He went out and got some experience. He used his graduate degree to pivot from one industry to another, and he had that experience to draw upon. So if you are thinking about grad school, I strongly recommend you go out and work first, because the graduate degree you think you want today may not be the graduate degree that you think you need in 5 years.
Right.
that's a great point.
I just think you get so many skills in the workforce. And I think if you're like me, I really like to look at GIFs and memes sometimes that symbolize our culture and where we are. And there's one that is really funny. It says that they're hiring for an entry-level position and it needs like 5 years or 10 years experience and it pays little to nothing. Or like the whole point of the joke is that like when you graduate, you don't have 5 or 10 years experience. Like you're gonna have to go like earn that, learn on the job, grow as a person. And I think your focus really does sharpen a little bit and narrows to, this is really what I want to do. Let me go either get the education or apply for that specific job, right? So I think it's just, yeah, and I think you're all over it.
So just to dig in real quickly a little bit more on, for those that are interested in this CFP idea, if you were to, become a planner, not to scare anybody away, but how much did you study for this exam? And I mean, compared to classes you took in your MBA coursework and undergrad coursework, what's it like?
And can you also twist the question a little bit, since they're still in school, are there classes that you recommend they take while they're in school, so that when they finish their undergrad, they might be better prepared than you were with education?
Yeah, well, I would say if you're anything like me as a kid going through college, I would say push yourself a little bit, just because you satisfied your math course requirement. This is definitely a subject that you would want to be good at or pretty good at. If any finance course that you can get into, I think would be powerful. I had thankfully both of those in both my undergraduate and graduate work. I would liken the CFP exam to probably similar to taking let's say 2 intense courses of college. Pack that into one, and that's how much you have to study. So every week, I would say on average, you're going to spend about 10 hours or so on the material. And you do that for a year, right? So it's like 2 really hard courses that you have to take for about 13 months. And then from that time that you complete your education requirement to the exam, typically you want to give yourself about a 3 to 6 month runway. And that's when you really crank it up. You're talking 10 to 15 hours a week. So I would come into work, I'd work, and then I'd go home and I'd study. And then on Saturday and Sunday mornings, I'd get up and I'd study. And you do that for 3 to 6 months. For me, it was like 5. And you should put yourself in a position to pass the exam. But this is an exam that has a 60% pass rate.
That's high. I mean, it can be as low as 40% pass rate.
Right.
So
We had 20 in our Belmont course. I don't know the results of everyone, but I know pushing two hands, how many people have not passed. So just know that it's a very intense, very intense exam. And it's probably like, I don't know, like name your hardest class. It's probably like that final, but you have to take two of them, one in the morning and one at night. So definitely worthwhile because it does kind of separate you from the pack. I got mine, I would say, earlier than some because I wanted to do that before I had children. This is a very big time commitment, and it becomes very hard if you wait too long. So.
All right, now that we've officially scared everybody away from getting a CFP designation, what questions might you have about what we do or our industry or about FBA or even the 6 tips that we went over before? We're wide open now.
Don't be shy. Your time.
So I have a question about the house. Earlier you were saying that the interest would be greater than the principal if you got a longer loan. Could you really quickly explain, because I've never bought a house before, could you explain the difference, just the basic bare bones definitions of principal and interest
Sure,
when buying a house?
Great question. Great question. All right. So in a fully amortized loan, what happens is the bank gives you a lump sum of money, and that loan will go to zero over a set period of time, 10 years, 15 years, 30 years. Home mortgages are typically 15 and 30 years. It's called a mortgage because your house is collateral. And if you don't pay your mortgage, guess what happens to your house? The bank owns it. They take over your house. All right. So it's something you don't want to mess up and you want to pay it. The way the amortization works is when the loan starts and you have 30 years, they calculate the interest on that loan amount. And if that loan amount is big, they say, okay, 5% interest or 3% interest times the total loan amount. And for 1 month, they say that's how much you have to pay in interest. And then whatever's left in your amortization payment goes toward principal. So on a 30-year loan, your very first payment, when they do the math on it and you can run the tables, the majority of that payment, so let's say you have a $1,000 payment on your mortgage and it's the very first payment on your 30-year mortgage. I can tell you right now, $900 of that $1,000 payment is going to go to interest and $100 is going to go to principal. And principal is the amount of the loan. So my $100,000 loan is now $99,900 after 1 month, but I've paid $1,000. Well, 900 of it went to the bank as interest, and only 100 of it went to the principal on your loan. So now I'm on month 2. I'm still going to have a big interest payment because I still have $99,900 of loan amount. So that's why on the very beginning of it, on 30-year loans, the vast majority of your payments go to interest. Now, one quick tip is if you pay one extra payment a year, so in my example, you're paying $1,000 a month, on your mortgage. If you were to pay $1,000, you pay $12,000 and you're able to throw in one more $1,000 payment for that first year, you cut 6 or 7 years off of a 30-year mortgage. You turn that 30-year mortgage into a 24-year mortgage. So that's a really powerful thing to do. And so we counsel clients and we say, listen, if you can't get to a 15-year mortgage, go with the 30. Let's make a little bit of extra payments. And if we can get one extra payment per year, we've just cut that mortgage down to 24 years.
Is that because it eats into the principal when you put in that extra?
That's it, because it's a principal only payment. We're not paying them extra interest. We're going to pay that. We're going to pay against the principal first.
And to your point, Kyle, you think about a 30-year loan versus 15, you still end up with the home, right? The same home, but you're just, I liken it to like cutting down a tree, right? With a 30-year mortgage, you're just hand sawing the tree. And it's a lot of effort and it's not very practical. you use a chainsaw on a 15 and you're going to get done with it quicker. You're simply just chopping away at it a lot quicker. And you don't really realize, I know I didn't realize, I bought my home about 4 years after college. I bought I had a 30-year mortgage because it fit my budget, but we made extra payments. And then when we got to about 25, we're in there about 5 years, we refinanced. And we took that 25-year loan and said, okay, now we want a 15-year loan because we're making a little bit more money. We can afford to do that, and it chops your interest again way down. So whatever fits in your budget, but there's creative ways to say, okay, I know I'm going to be in Nashville a while. I'd like to buy a house. We want you to do a 15. If you can't, simply stack that money on top of your normal mortgage.
Thank you. That helps a ton.
Yep.
Good question, Kyle. Anybody else with a question? Don't be
I'm gonna
shy.
off of the mortgage thing that you just mentioned. So when is like a good time to like refinance, or how to know if refinancing would be better for me or not?
Sure. So rule of thumb, and Taylor can tell you, we've done a whole lot of refinancing for clients in the last 12 months because mortgage rates are truly at historical lows. Rule of thumb is, is the rate 1% lower than what you have now? If it's 1%, we typically can get something done. There's enough there to do it. Now, it depends upon the size of the loan. If you've got an $800,000 loan, it might make sense to do it at 0.5% because there's more room to work with. If you've got a $50,000 loan, it's harder to do it because the banks, there's some hard costs associated with the refinance that you just can't get. There's some hard costs in the refinance that are there no matter the size of the loan. And so those have to be amortized over the cost of the refinance. But the short answer is you typically look for about a 1% differential from the rate you're paying and the rate you can get quoted. And there's a way you can do the math and you calculate the break even as to how long it takes you to break even from the refinance. That's a little bit more of a deeper answer, but the short answer would say I'd start with, if you have at least 1%, you're definitely in the ballpark to give it a shot.
And to another point, just to further answer that, there are a lot of different pieces of mail that you will receive in the mailbox that says interest rates are 1.5%. And you look at your mortgage and you think, well, golly, I bought my house and it's a 4% loan. I'm going to have to refinance. Well, understand there's different types of mortgages, and you'll definitely want to consult with not necessarily the lender, because they're going to do what's in the best interest of the lending company, right? But potentially a financial planner that says, is this an apples to apples comparison? So we'd love for you to have a fixed rate loan, but maybe they're presenting that 1.5% loan that's a adjustable rate. So you can, I just say, be cautious.
Right.
Not everything that you receive in the mailbox is true, right? Like, just like they can't lie on the internet. You just have to be careful, right? I would say refinancing can be a wonderful thing. And to Craig's point, we have done, it feels like 100, because in the financial planning process, if you are my client and I know that I can save you over the life of your loan, I can save you $100,000 just by getting a better rate, then yeah, it's in our best interest to do that. Whether you move that money to under our management or pay off other debt, that's none of our concern. We're doing it because it's in your best interest. So I would say, yeah, those kind of points I think are really powerful to make.
And I get, find a banker you can trust. They'll help you figure out the right answer on that. And if you quite frankly, if you need to find a banker, we don't get paid anything from it, but if you need a reference to a banker, or ask a friend or something, somebody that they can trust, but find somebody you can trust from the banking standpoint.
So either Craig or Taylor, and this is kind of a two-part question. At what point do you think people should get a financial planner? So at what level of net worth should a person get a financial planner? And if you can also speak to how much it costs to have a financial planner, and how you're making your money as a financial planner.
Yeah, that's a great question. I'll take a first stab at it. So how we get paid, and for our business model, we only have so many slots of people. We're capacity constrained. We work with about 250 people, families. We have 6 people, So our business model is set up to work with people that probably have, $250,000 of investable assets and higher. So we work with people that have, our average client has a couple $1,000,000 of investable assets. I fully recognize that's not for everybody. So we're a niche kind of provider. I do think there is a level where it makes sense for you to go get some help, to go talk to a financial planner. There are planners out there. There are different online services that can do that. The one cautionary tale I would say, or warning I would give is, unfortunately, some of those that tend to work with people that are starting out have historically been very sales oriented. They're just trying to sell you something, and they're not trying to offer you advice. And so I know there's been some that are more online based that have been, I think Vanguard has something that's actually pretty good, that has CFPs you can consult with at a pretty low, financial profile, if I can say it that way. But there are definitely ones out there that again, they're just trying to sell you something.
Yeah, and I think, so people get paid different ways in our industry, and I would encourage you guys to make sure that you have a lot of things in place before you really worry about a financial. So when you buy a home and you have a family, I think you're on the verge of saying, okay, well, I need to make sure I have some things in place, right? That's a simple phone call to, it could be an online service or someone maybe that your parents work with, and just say, hey, am I on the right track? Am I doing the right things? Do I have the, something that people think about? I think maybe the one thing that kind of screams red flag is you start a family, right? You're responsible for another person. You maybe have a kid and you have any life insurance, right? I mean, there are people that will sell you life insurance when you don't need it. But like just knowing some of the core basics of like, what do I need? What am I doing? Am I saving enough? Those are things that I would say someone that you already have in your life, like maybe your parents' financial planner or online service. Vanguard's a huge one. It's cheap. You can definitely dial a 1-800 number from that company at least and get pretty good advice. But with boutique style shops, whether they're in Nashville or wherever, you're gonna get more personal service, and it's gonna be probably later in life when that's appropriate.
Thank you. And I think it's important as students, if someone's trying to sell you something or get you to invest in something, a good question to ask is, are you invested in it? Because if they're not invested in it and they're trying to get you to, you're probably not talking to the right person, right? So have some basic questions that you always ask before you believe what you're being sold.
And I would add to that, Ann, as how are you getting paid on this?
Yeah.
Absolutely. That's a very fair question to ask.
Yeah.
If it's too complicated to answer, then it's probably not for you.
Yep.
I think that's fair to say too.
Yeah. So we got about 5 minutes left. Does any student have one last question? Kayla, you're smiling. Do you have a question?
I do not. I can't think of anything offhand.
Anybody?
Craig,
Yes.
Taylor, congratulations on your CFP. I know
Great, I'm so happy.
I know you are. I know you are, Patty. I know you are. I would ask the two of you to speak to our students about the philanthropy side, the giving side, and what that might look like. Again, as they're just starting out their professional careers, if that is an interest in them, and how to start now with maybe not making an impact now, but what that looks like going forward.
So yeah, I think, one thing in my experience is I tell people you have to be a gracious giver and a gracious receiver of gifts. And so how you're a gracious receiver of gifts, and if you graduate college, sometimes you get gifts from family and so forth, is you got to be a good steward of that gift. And so you have to have a plan, you have to have a budget. And so it empowers you to ultimately then turn around and give some money away if you wanted to be so charitably inclined. So, starting out, I don't think there's any amount of money that there's no threshold that you have to make before you feel comfortable giving money away. I don't think that exists. I think you got to find something that you're passionate about. You got to understand that they're, a quality organization, or they make a difference in the world, that you want to help them make a difference. And then there's lots of ways you can do it. You can, via online. I mean, what we get into later on as people get more sophisticated about their giving, and it doesn't mean it's any more or less good to do it. But we get into where our clients set up charitable funds. And so they're able to do their gifting in a very tax efficient way. And so it makes an impact. They're able to give, and it actually then saves them taxes by doing that. And so there are techniques that probably beyond this conversation that can help you do that. But if I was starting out and trying to feel like a way to give, I would just make it part of my budget. In fact, when I give these talks, typically the first thing I put in there, is give. And whether that's a faith-based element or whatever in your life, but giving is a very powerful thing.
Yeah, I would echo putting it in your budget early so it becomes your budget for life. It's not a new thing when you make more money. It's just, okay, I got a first job, I make $30,000. Can I afford to give $1,000 a year? Maybe you can, or maybe you can't. Maybe it's 500. But getting in the practice of giving, I think, goes a long way. So when you do make more money, say you make $100,000, is $1,000 enough? That's a question for you to answer, right? Maybe it bumps up with your growth. Maybe it should. But yeah, to Craig's point, I think whether it's faith-based or passion-driven, I know, there's a lot of good dog organizations. I have four dogs, so I like to pump that a little bit. I think everyone gives to what they feel passionate about, but getting in the practice is definitely key.
Thank you. So I'd like to thank Craig and Taylor and Kerry, and I would invite them to stick around just for a minute. And I thank the students that actually showed up, and I hope that you've learned something from this. And if I can do anything for you, just shoot me an email and we'll see what we can do to help you out. All right. Thank you, students.